obviously there's some up periods and down periods, right? The tide raise all boats or not, right? So if the market is collapsing 20%, most likely everything is, right? That reminds me of myself where I lost money again on this stock, which is, well, one stock was quoted $5, right? And it literally had cash and equivalent in his balance sheet of $4.95 of cash and equivalent. So I said, this company is just like rock bottom. It's priced at 5 and it has 5 in his balance sheet. So this is the perfect company. No collapse, nothing, right? But zero growth. The company went nowhere, right? So this is from the balance sheet, a good company because it has plenty of cash, but goes nowhere. So it's not a good company. So really focus on the income statement rather than the balance sheet. And then the timing is everything. That's why you're doing this. You focus on technical analysis because you know that timing is everything, right?
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, I'm speaking with Alex Carteau. Alex is the president and co-founder of EPS Momentum. He's one of my former Bloomberg colleagues. We used to work together back in the day, different groups, but same firm. We've kept in touch since then, and he and his team have recently released a new platform to help investors better understand earnings momentum. So today we're going to talk all about earnings, how stocks tend to trade around earnings, how you relate the short term to the long term around earnings releases, why it's important to anchor to the earnings date, and how earnings momentum relates to price momentum. So please enjoy this conversation with Alex Carteau. Super excited to be sitting down today with Alex Carteau. Alex, you and I are former colleagues, and it's awesome to be sitting down with you in this venue. Thanks for joining us on the show today.
Thank you. Thank you very much.
You and I have talked about earnings quite a bit in our times when our paths have crossed in recent years. And I'm super excited because you guys have created a pretty fantastic platform called EPS Momentum, which I know we're going to talk a lot about the capabilities and how you're using it to understand earnings growth and earnings opportunities. But start us off. Let's set the table for this meal we're about to eat together. Tell me, I was taught in my Fidelity years, it was ground into my head. It was pounded into my head. Price follows earnings. So as a technical analyst, I had to understand earnings because that's where the price is going to gravitate to. In your experience, is that proven out true? And how do you quantify those two things in a meaningful way?
Well, I guess it's true and it's untrue, right? So it's true because, well, I guess if a company is making more and more sales and then earnings by the end of the day, you would assume price would follow, right? The reality is that sometimes, very often, price leads the change of earnings in a company. On top of earnings, there's thousands of guys that are doing their daily job every day, and those guys are analysts at the sell side and buy side, and those analysts really analyze company and come up with forwards and estimates on where every single company is going. So as those estimates get revised up or down, price literally follow these estimates. So I would say I would rephrase your sentence more into estimates are very important. And earning per share are more backward looking, right? So as you get the financials, they're 90 days old ish. So looking backward, but it's a confirmation from the analyst estimate. So they'll go both hand in hand. But yeah, you were right.
And I love what you said. I don't have the ability to give honorary technical analysis designations, but you get a partial one there for talking about how price often leads earnings. Because I would agree with you, right? A lot of times the earnings kind of are reflected later, but you're, I think, hitting on a key point that I think a lot of institutional investors kind of take for granted and understand, which is it's all about future expectations, right? It's all about expectations for future growth. I think for individuals, we think a lot about how much has this company made. Can you talk a little bit more about the forward-looking part of earnings and why we're really looking for changes in expectations and not changing in, because I think at this point, we're in a situation where a lot of companies are not really getting fantastic earnings at the moment, but it's the potential that's so promising, right?
Yeah, exactly. So, one thing that is very difficult to do is an analyst would usually come up with an estimate for this quarter, next quarter, 6 months out, 9 months out, even 2, 3, 4 years out. And all these are 8 or 10 different variables that you would revise up or revise down. As an investor, it's sometimes very difficult to assess whether the prospect for a company is getting better or not, because some estimates get revised up, others down. So if I say to you, The next 2 quarters are revised up, but year 2 and 3 forward are revised down. What do you get out of that, right? So what we do is we put in a system that takes all those estimates, average them all, so take all the means of all the analysts out there, and really create one metric that tells you if analysts are positive on the name and revising up or revising down. So it simplifies the process completely. And if you follow that revision score, so estimates revision score, you have a pretty good indication of where things are going. And the second thing, I'll add one more thing on this is, let's assume you have a company that is expected to produce earnings per share of 1.2, right? And it comes out to be 1.21, right? It's not so much the 1.2, 1.21 that matters. It's really the growth of where that 1.2 was before, right? So if 30 days ago that 1.2 was 1 or 110, you can see the growth growing 10, 20% over the last few weeks. So that's very important. And then the analysts revise it up and say it's 145. So then you see growth and acceleration of growth, and that's the important thing. Not so much whether the 1.2 beat the 1.21 or vice versa. It used to be very important. It used to, at Wall Street, where you get that number in the 80s or 90s, everything was very, very slow. Newspaper, people would run in the street, go and tell a guy who tells a guy, another guy, and that's it. Now it's in a fraction of a second. So it doesn't matter if your 1.21 beats the 1.2, the beat or miss is, for me, an outdated flag. What's really important is what is the trend of those analyst estimates revisions. Is it going up? Is it accelerating? And that is the key. So people very often get confused. I got a beat on the estimates for this stock for this quarter. It should go up, right? Well, actually, no, because the CEO speaks at 4 p.m. on that specific day and says, well, this quarter is going to be challenging and so on. So there are things that are contained in that discussion or earning call that really trumps that miss or beat that you get from the numbers.
I'm so glad you went there, Alex, because I was going to ask about that. And I think you're right? And we've seen that even recently where a company beats earnings, quote unquote, and then the stock goes down, or they miss earnings, but the stock goes up, and people sort of feel like there's a big disconnection where honestly it feels like they're looking at the wrong data in some ways, I guess, right?
So the explanation there is fairly simple. Analysts are looking at growth. Everyone is looking at growth. I want company growing. You don't want company shrinking. So that's the first assumption. Second assumption is, let's assume you have a company that grows 20% every quarter. 20%, right? Is it a good company? Does that make sense? Well, Wall Street doesn't. If you grow 20% 3 quarters in a row, we're kind of flat. You're still growing 20%. It's fairly boring. However, if you do 20, 30, 45%, now that's interesting. So that the growth is not so much that important. It is important, but it's the acceleration of the growth. So what we focus on EPS Momentum is the acceleration of the growth. Growth, of course, but the acceleration of that growth. So again, if this quarter I tell you a company is growing 20%, and you say, well, that's great. That should be a great company. I'll say, well, last quarter was 35. I'll say, well, so it's slowing down then, right? So what's really important is the acceleration of that growth. And you got to have the tools, you got to have proxies to really analyze that very quickly on thousands of companies to be very efficient and get the right timing. So this is where we put in place things that are very different from what you get out there, is really focusing on acceleration.
And I would say on the technical analysis side, that's a common issue as well. You think about a trend, but you don't think about how much the trend is accelerating, what we call the slope of the trend. And that change when a price accelerates versus slows down, that means two very different things in terms of how expectations are changing. I want to get more about some of the ways that you're kind of scoring and how we can identify ideas, across a larger sample set. But before we get there, the short question is, how do you know all this stuff? The somewhat more verbose question is, you and I overlapped at Bloomberg. Were there experiences that exposed you to this way of thinking that helped you appreciate that this is kind of the secret sauce that you need to understand to really identify good earners?
Well, first, I'm passionate by stock and stock market. I've been buying stocks since I was 14 years old. So that's my story. And then second, I really enjoy my time at Bloomberg, seeing investors left and right, traders, analysts all around the world, literally all around the world, from Asia, Europe, US. And I worked with thousands of analysts and traders like you did. And sometimes you meet 2 or 3 guys that are very different, and they teach you something that is unique. And I mean, it sounds simple, but I met some people who just told me, this is what I'm looking for. This is what makes a stock go up or not. These are the metrics that are important. Focus on that and come up with ideas of this. And so I would came up with some ideas to help him out and using the Bloomberg terminal. And he loved those ideas. And then he sent me more ideas. And we iterated several times like this. And before you know, I learned the real intricacies and learn the ropes about how to pick stocks. And I figured, one day I would take all that knowledge and package it into a system. So a system is born. It's EPSMomentum.com. And yeah, that's my story on this.
I love it. Do you remember the first stock you ever bought in your own personal account?
Yes, I did. It was a terrible experience. I bought a European stock called Eurotunnel. So it's basically the tunnel between Paris and London. And it was I think I lost 95% of my investment. So it was well, listen, this is how you learn, right? So and I've done that several times.
Like a phoenix from the ashes, we grow from those early experiences of
you
loss.
learn your lessons. You learn your lessons.
It's the tuition we pay to the markets, Alex, is what I was
Exactly.
always taught. So if it makes you feel better. All right, so let's talk a little bit more about this concept of EPS momentum, and the product that you guys created is called EPS Momentum. What does that really mean in terms of the momentum of earnings? How does that relate to price momentum? Because when a lot of people say momentum, they think price momentum. So how are those related?
EPS momentum has 2 meanings for us. So first, earning per share momentums, and that's the driver or derivative of the driver. And then it's also E and P and S, which is earning, price, and sales momentum. So those are, if you boil it down, the other 2 other metrics that are very important is price and sales. So our initial model took earning per share, sales, and price into account. And now we have 4 metrics that I think represent a company and its growth. It's earning per share, sales, free cash flow, and profit margins. Those are the 4 metrics where we actually look at momentum historically, not quarter to quarter, but year on year, quarterly, over several years, first off. And then second off, we look at disruption in that trend, or is it trending higher up in a nice way? We look at acceleration on those metrics, and then we quantify all this and come up with a score. The score is between -50 and +50. And that earning momentum, we call it earning momentum as a whole, it helps you save time and focus on the companies that have positive earning momentum versus negative one. So, and I tell you, if you take all 5,000 US stocks and you just say earning momentum greater than 0, before you know, you focus on only 300 or 400 of them instead of 5,000, right? So right there, it's separate the wheat from the shaft, and that's useful. And then what you need to do is, follow the trend and that earning momentum, and you'll find good stocks. Now, as far as price is concerned, we have a timing momentum. So the price is always, well, I can find a great company, but if it's not the right timing, forget it. Conversely, well, this chart looks amazing, I'm going to buy this one, but there's no growth. There's no earning growth. Maybe it's just speculation. And then before you know, you're down 30% the next day, right? So timing momentum and earning momentum have to work in tandem, and they cannot be mixed up because you don't mix up price move with earnings and estimates. They have to be taken like isolated as 2 different objects. In your brain, you have to compile those 2 and say, well, I want good companies, good earnings, good momentum, and I want companies with good price momentum as well, good timing, right? And that's what we came up with, the time momentum. So time momentum is more from technical side. So it's a series of indicators, 5 different indicators based on price, strength, acceleration, and trend.
If I was tempted to authorize some sort of honorary technical analysis designation, now I'm very motivated, Alex, by what you just said, because you combined, I think you articulated a meaningful way of relating good companies to good stocks, right? And that's something we would often throw around in my Fidelity days. Good companies don't always make good stocks, because we would run into trouble when we found a good company. It seemed like a good opportunity, But if the price wasn't reflecting that opportunity at the time, then the timing just was wrong. And so, it wasn't worth it buying things that were just gonna hurt the portfolio. So looking for those, combining those two in a meaningful way is pretty helpful. How do you in the platform or in your approach to investing, how do you kind of balance? How do you weight? Which of those is more important? Are they equally important? Do they change in importance in terms of different parts of the market cycle? And not just price versus earnings, but in each of those different metrics, right? You've got a number of different ways you're evaluating, sort of fundamental momentum. Do those weights shift, or should they? Or are they more consistent based on what tends to work over time?
So obviously there's some up periods and down periods, right? The tide raise all boats or not, right? So if the market is collapsing 20%, most likely everything is, right? So there's good timing or not. So we've incorporated the flags, like, very simple moving averages, 2050, where, well, if everything's tanking, just don't try to grab a falling knife, right? So that keeps you out of the market. From a fundamental standpoint, when I hear you say good companies, I got to say something though. The good companies are, you have to define what the good companies. So we define it as earnings and growth and acceleration, more sales, more earnings. Some people would say, well, no, I want value with a moat and no debt and all this. That reminds me of myself, where I lost money again on this stock, which is, well, one stock was quoted $5, right? And it literally had cash and equivalent in his balance sheet of $4.95 of cash and equivalent. So I said, this company is just like rock bottom. It's priced at 5 and it has 5 in his balance sheet. So this is the perfect company. No
Right.
collapse, nothing, right? But zero growth. The company went nowhere, right? So this is from the balance sheet, a good company because it has plenty of cash, but goes nowhere. So it's not a good company. So really focus on the income statement rather than the balance sheet. Although one of the exceptions is I would look at the debt to equity ratio, of course, minimum, so that you don't buy over leveraged companies. But anyway, so that's on the fundamentals. So obviously in market downturns, you have companies that are obviously slowing down, but most of the time if it is a growing company, then it will follow the sector, right? So if the sector drops a little bit, but then recover, these will be the first company that will recover. They will be the leaders of the sectors, and you will be well positioned to benefit from that growth. Yeah, and then the timing is everything. That's why you're doing this. You focus on technical analysis because that timing is everything, right? So what we did on timing is, instead of stacking up RSI and MACD and DMI and stochastic and all that and stacking them up, what we did is we took a different object. So there are things that are contained in the timing momentum. So one is trend. So obviously we look at stocks that go above and beyond their average true range. So really trending upward or downward. So that's the first thing. The second thing, we look at price acceleration. Again, this concept of acceleration is key to us. So we use rate of change to really monitor that acceleration. And the third is we use the allocation of money. So I call it allocation of money, but people call it relative strength, which is basically, why would an asset manager buy AMD and not NVIDIA or Intel? They would allocate their capital in one way or another. So that's relative strength to us. So it's basically a ranking of all 5,000 stocks in the US, and then we have 4 views: the 1, 3, 6, and 12 months view, where we compact it all into composite, and then we have the relative strength composite for that stock. And then we take volume in. So the volume is kind of a weird animal, but it's nonetheless one of the most important. Volume is power. So if you have a 1% move on the stock and no volume to support it, go back to your Wyckoff books, it means nothing. But if you have power days, we call them power days. So we have specific days where the market, that stock is moving significantly on big volume. And usually in a year, there's always this say that goes about, there's 20 days in a year where you make your portfolio, or, where you make your return. And those 20 days actually shows up. So those power days, there's usually between 20 to 30 power days in a year. And when we focus on these, we see them as turning point from uptrend and downtrend, because big investors would, so it's like their liquidity zone. So big investor would jump in and push the price up because of their size, and then it will trickle down over several weeks and push the price up in a rally form. going forward. So those are the things: strength, volume, acceleration, and trend are 4 things that we put inside timing, and that helps us stay out of, I would say, bad stocks, bad timing stocks, and sectors as well.
I love, as I was reviewing, some of the ways that you guys are quantifying the technical trends or really the price momentum. I would say very well done, particularly when you're talking about average true range, right? So you're basically adjusting for when is a move actually a meaningful move and not just kind of the noise, right? Trying to separate the signal from the noise, which is great. Focusing on relative strength. I think you and I both spend enough time with institutional investors because that's how you're evaluated, is your ability to outperform. So focusing there, and then volume and recognizing that the bigger volume days have meaning, right? There's something behind those. So I think those are great. Those are beautiful concepts. And if you're alluding to, people like Wyckoff, you've done your work, Alex, I would say, in terms of understanding the technical analysis body of knowledge. Well done. Let me ask you this. And one of the big challenges I think a lot of people have when they think of earnings are the gaps, right? The price gaps that often happen around earnings, right? You have these, it's sort of a binary outcome. You gap higher, you gap lower, and all of a sudden it feels like everything changes. In your approach, right? How do you sort of address gaps? How do you adjust for gaps? How does that impact your ability to evaluate momentum?
I think there's 2 parts in the answer. So, how to behave during earnings with the gaps and how to handle the gaps. That's one way. And then the second thing is we take stocks very differently from everyone else. Instead of looking at stocks on the 1 day change or 5 day change or 1 month change or year to date change, we don't analyze stock like this, and we don't put that in our model. What we do is we take stocks in their breathing rhythm. So stock would breathe in their own earning quarter, not the calendar quarter, their own earnings quarter. So if AMD reports tomorrow will be an important point for AMD, and then it will go on for 90 days without really information, of course, outside the next Anthropic model or any news that comes out, right? But the company in its own and the CEO and the CFO will just talk a lot tomorrow and then just basically stay silent for 3 months. So there's really a window where there's a lot of volatility, 1 or 2 or 3 or 5 days where they're allowed to speak and talk on this and that. And then there's the silent period where the market does what it does, right? So that period of the gap, the earning gap on day one, is very, very important. You remember I just mentioned that the beat or miss is irrelevant now. I truly think that's absolutely irrelevant. I keep listening on TV, oh, they beat their earning, they missed this. I mean, it's irrelevant. However, the sentiment and the market reaction just after that earning, that is key. Again, that earning call starts at 4 p.m. Even before 4 p.m., the stocks already move up or down. So that's the first reaction. So this is off market, right? So volatility, the volume is very low. You don't have a lot of liquidity, so price tends to spike up or down. Then the CEO speaks for 30 minutes, and then or more, an hour. And when the call ends, the stock moves either up or down or in a very significant way, or just nothing, just doesn't move. But that initial move is mostly maybe a few blocks, maybe retail. But the big guys who are looking for liquidity, who need liquidity in order to trade, they might have done some swap on the side that we're not aware of, but most likely they wait for a little bit more liquidity. And that liquidity comes at 9:30 the next day. And so what we do is we isolate the jump before the beginning of the next session and the move during the first day. And so we have plenty of tools to capture that earning gap. We also have this concept of earning shocks after 1 day, 2 day, 3 day. And companies that have tremendous earning shocks are meant to have a very good quarter overall. So let's say they jump 15%, most likely they'll finish their quarter up 25 or 30%. So it will trickle down over several weeks. So if you invest in this, it's pretty much Las Vegas casino, right? Because you actually don't know if it's going to be a good quarter or a bad quarter. There's ways where you can see before earnings if there's little faint trend in people who know. So what we do offer is the ability to pre-earnings 5 or 10 days before. We track the revision score estimates. And if that estimates trickles up a little bit, that means analysts are bold enough to modify their estimates just before earnings. And that's noticeable. I mean, this is something that you have to pay attention to. And then prices as well. So if price trend starts trending a little bit inside earnings, with the estimates supporting it, with a little bit of volume as well. Maybe you'll look at the option market, which we'll do at a later stage. But if you take all that, then you have an insight as to probably it's going to be a good earning. But my point is, if you trade during earnings, it's going to be extremely rewarding, extremely risky. So you can be up 20% and then the next day minus 25 or minus 20. And that tells you that you're down. Up to you, up for grab. There's a lot of people that are high frequency trading this. Getting in, getting out very quickly during the day, during day 2, during day 3. So there's a windows of 3 days where we said to our user, listen, you can play those 3 days. It's going to be very rewarding, but very risky. If you're up for it, fine. But you could lose your shirt on this. What we tell them is really focus on the movement after the 3rd day. So if the 4th, 5th, and 6th actually beat the top of the top 3 days, then you're onto a special quarter. And we've analyzed all those earning shocks and earning gaps over 10 years, so about 40 quarters going backward. And I dug into the mountains of white papers that have been written on the post-earning announcement drift. And I found one guy called Fama, of course, famous Nobel Prize, who said, post-earning announcement drift is one of the most extraordinary human behavior bias that in stock picking, right?
Mm-hmm.
So what does it say? It's called the SSUE. It's called surprise estimates phenomenon, and it used to be based on that beat or miss flag. So reminder, that was 1999, and even that behavioral finance, the first papers on this were from the 60s, and so it was a while back. So what it does say is, well, if you're surprised by an earning, there's a human bias that says you are either underreacting or overreacting. So if investors are underreacting, there's a positive event, and you're underreacting to your positive event. Let's say you just buy 10 million shares because you're a big investor, you buy 10 million shares, and you see the shares trickling up again and again. You say, geez, I didn't buy enough. So then you buy 20 more and 30 more all the way to the end of the quarter. And then you push the price up for the next 90 days and sometimes even for the next quarter. So that was underreaction. There's also overreaction where you actually buy those 10 million and actually the price shuts down or trend downward. And you've overrated and you're like, oh, maybe I should trim a little bit my position. I bought too much. So that's the drift down. So we've quantified all this and created analytics called the post-earning announcement drift, where we come up with the forecast of the stock price over the next 90 days. So in conclusion, and to answer your question, there's 2 plays. Either you play the earning gap, the 1, 2, or 3 day, and you can have fun. Or so high reward, high risk, or you start paying attention of where the drift is and where the stock is going to go in the next 90 days with our post-earning announcement drift. And then you will buy on day 5, 6, 7, 8, 9, 10, 20, and you will have a nice uptrending or downtrending, but that uptrending chart that will give you nice reward with a very little amount of risk. Again, outside crazy news and wars, but this is what we've done, and we've backtested that. So, and it's a very significant result and return.
Yeah, Alex, that was really well said, and I love how you describe sort of anchoring to the earnings release, the earnings date, as a beginning, because that's something that has always bugged me and all other technical analysts about any sort of quantitative approach. When you sort of hit this arbitrary, like 1 month or 3 months, as if that's a meaningful period to compare stocks. And I think you're anchoring on what actually matters to these companies. And just to finish up, and Alex, this has been a lot of fun. I'm sure people are drawing some great insights about just how to think about earnings. Hopefully, you've challenged some expectations from a lot of people listening. What areas of the market stand out here, right? We're in a period where the S&P and the NASDAQ have been relatively flat. They're starting to skew lower here. There's a lot of big question marks for investors about where opportunities are. Are earnings even positive or negative given all of these uncertainties? Are there areas of the market that stand out to you on the upside that are sort of stronger EPS momentum types of names? And are there some that maybe surprise to the downside that are weaker than expected here?
I mean, this is the crystal ball question, right? So what I do is I rely on the analyst and what they say.
Mm.
Well, we can see, we can monitor on the side here. We can obviously see computer technology being one of the best performing sector, not just in price, but in actual analyst expectation. So there's up and down and whether AI is a bubble or not a bubble, but overall, it's by far the best sector in terms of not price move, but earning estimates revision
Sure.
over the last 90 days and over the last earning day for every single of the stocks that's in that sector. You have aerospace. So, of course, there's war in aerospace and unfortunately missiles and armament and all that. Industrial products, those are the three sectors. But I would say consumer discretionary and staples are not in fashion and finance, right? So finance is significant little brewing debt crisis or private credit crisis coming up right now. Plus the rates not being lowered, so the financials are not in a good place. But yeah, so it's difficult because you have an S&P making almost its high or close to its high, and yet there's war there, there's crisis everywhere, but the S&P is still making highs. So yeah, I guess this is conflicting views as to a booming economy, which is there, and with booming technology and a secular trend in improvement in technology and AI and how it's changing everything. And at the same time, you have war and crisis and maybe some inflation.
I feel like it's always a tough time, but now we've got this combination of challenging macro factors. To your point, Alex, it's interesting. Some of my recent guests have talked a lot. How do you navigate a period where there's geopolitical conflict and everything in the Middle East and elsewhere? And their comment was, look, when it actually starts to affect companies' ability to earn and ability to grow, that's when the market's really going to start to experience some negative shots. So I it sounds to me like you guys have done a great job creating a platform where people can start to quantify those changes in expectations. So something certainly to think about. Alex, this has been a lot of fun. I really appreciate it. Congrats on EPS Momentum and what you guys have done so far. I hope that our conversation has helped people think about how they think about earnings and given them some ideas about what's next. I hope we can continue the conversation down the road. But for now, I say thanks so much for coming on the show.
Thank you, David.
It was a fun conversation with Alex Carteau. I hope you enjoyed that sort of deep dive into all things earnings. I love talking to someone like Alex who's actually gone through, done the work, and researched historical earnings trends to just sort of try to understand what sort of insights we can gain. A couple things come to mind as I'm reflecting on my conversation with Alex. First, that idea of focusing on each stock's kind of earning quarter, right? Instead of thinking of all stocks sort of on the same timeline, looking at the last month or 3 months or something in terms of return profiles, anchor to the earnings date. Think about how the stock trades in the couple days after. Think about how the stock trades a couple days after that. And that's really the backbone behind and one of the pieces behind this EPS momentum strategy that they've been able to develop. Second thing was, not just thinking about growth in earnings, but the acceleration of growth in earnings. A lot of times we think very simplistically about trends in earnings. As long as the company keeps making money, that's good, right? According to Wall Street, that's actually not so great. That's actually just okay. The acceleration in growth, the improvement in growth rate is where stocks usually are rewarded. And as we discussed, most often price does indeed follow earnings. Talking about earnings gaps, which is an area that I know a lot of individual investors struggle with, right? What do you do around earnings releases? And I loved Alex's comments about how to think about the post-gap performance. That's something we talk a lot about. I know on my market recap show, thinking of what happens after, how Alex described as the post-earnings drift. We always talk about a gap and rise or a gap and fall pattern, what that means as investors actually change their positioning a couple days after earnings. That's something I definitely I'm going to reflect on going forward after this conversation. I sort of wanted to get Alex to talk about what investors misunderstand the most, and he kind of offered it up toward the beginning, that literally it's the difference between earnings, right? A company earning money and earnings revisions, right? It's all about expectations. And on the institutional side, would think a lot about earnings estimates and estimate revisions. And I would encourage you to think about that. Remember, earnings are always forward-looking. We always want to think about projected growth rates and then actual growth rates. And that's what the game really is. It's not about whether the company made money for the last 12 months. It's the expectations of their ability to grow that earnings potential in the next 12 months, the next 24 months, and so forth. Finally, from a technical analysis perspective, pretty strong effort, I would say, with the price momentum capabilities that we talked about. Average true range is one of those classic, really smart ways to separate the signal from the noise on the charts. Average true range basically tells you how a stock tends to trade. And so looking for moves outside of that can be really meaningful. And I love the focus on relative strength and volume as well. Really impressed with EPS Momentum. You can check out more about their platform, by the way, if you go to marketmisbehavior.com/EPS. I've really enjoyed exploring the platform. I've got a lot to work on after talking with Alex. I was talking about after I said I took a bunch of notes. I'm going to be digging into things soon after and sort of see what sort of discoveries I can make, especially thinking about scanning and sorting, right? Looking for new opportunities that are emerging using price and earnings and their double strong sort of reading on key stocks that I'm thinking about. Again, you can find more info at marketmisbehavior.com/EPS. Thanks again for Alex joining us on the show and sharing a lot of the background behind that awesome platform. By the way, if you want to learn more about some of the technical analysis tools we alluded to, things like average true range, assessing trend conditions, measuring relative strength, and analyzing volume moves, our Market Misbehavior Premium members could be a great way for you to upgrade your own performance potential in 2026 and beyond. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance with our virtual courses. Second, you'll have access to our premium member reports, like our weekly flight plan and our monthly chart review. We'll keep you informed. We'll keep you understanding the context behind the day-to-day flickering ticks in the markets. Finally, we'll help answer all of your questions because you'll be able to access our member community where you can ask questions 24 hours a day. You can learn from other like-minded investors and navigate these markets with a team of mindful investors. You can get all of that and more if you go to marketmisbehavior.com/premium. And don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today's episode of the Market Misbehavior Podcast. Thanks so much for joining me. My name is Dave Keller, reminding you it's always a good time to own good charts.